Hey, good evening, ladies and gentlemen, and a very happy new year to everyone. And thank you for tuning in to our Corporate Connect today. I'm Sunny So, your host for today. And this evening, we welcome ESR-LOGOS REIT, as well as our audience from Facebook and Mumu Live. This webinar is organized by SIAS and supported by SGX Group. We will kick off today's webinar with a presentation by Mr. Isaac Lim, Market Strategist at Mumu Singapore, on recent market highlights, followed by a corporate presentation by Mr. Adrian Chui, Chief Executive Officer and Executive Director of ELOG, and we'll end off today's session with a Q&A. ESR-LOGOS REIT is a leading new economy future-ready Asia-Pacific S-REIT listed on the Singapore Exchange since 25th July 2006. ESR-LOGOS REIT invests in quality income-producing industrial properties in key gateways. As at 30th June 2022, ESR-LOGOS REIT hold an interest in a diversified portfolio of logistic properties, high-specification industrial properties, business parks, and general industrial properties, with a total assets of approximately 5.5 billion Sing dollars. Its portfolio comprises of 83 properties located across the developed markets of Singapore and Australia, with a total gross floor area of approximately 2.3 million square meters. As well as investment in 3 property funds in Australia, ESR-LOGOS REIT is also a constituent of FTSE EPRA Net REIT Global Real Estate Index. ESR-LOGOS REIT is managed by ESR-LOGOS Fund Management Limited, the manager, and sponsored by ESR Group Limited. The manager is owned by ESR 99% and another 1% by Shanghai Summit Private Limited. Without further ado, I will now invite Mr. Isaac Lim to give us an overview on how the market performed. Over to you, Isaac.
Hi, thanks so much for the introduction, Sunny, and Happy New Year to all who are attending this webinar. So thanks for your time joining us this evening. Without taking up too much of your time, right, let's get right into it. So just as Sunny has already introduced, I am Isaac, the current market strategist over here at Mumu. So very pleased to be connecting with all of you and sharing a little bit about the recent market updates. All right, so just a quick broad overview of the markets, right? These are some of the, sorry, just go back. Yeah, this is just some of the key market indices that we are, or rather my side, we're currently watching, at least since the start of 2024. So very clearly you can see that the leading market over here that is really outperforming all the other indices is actually the Nikkei 225, right? Since the start of the year, the Nikkei has already accelerated, right? Gone a lot higher and added a 13.45% gains year to date, right? And then of course you have the tech-heavy Nasdaq 100 that's added a 6.28%, followed by the S&P 500 that has also added a 5.28%. Now this is mostly due to the tech-heavy index that actually takes up quite big market capitalization on this indices. Now, over on the other side, right, closer to home, okay, you have the Hang Seng Index, and of course, we are taking a look at both the Hang Seng and the CSI 300. Now, these are the Chinese indices, and of course, not surprisingly, given the current drop in the Chinese index and the lack of investors' confidence in the economy over there, you have the Hang Seng dipping by negative 7.63% year to date, and of course the CSI as well, negative 1.93%. Just let me. Okay, I just saw.
Yes, Isaac will provide some visuals for us.
Yes. Okay. So yeah. So over here, I hope you guys are able to see my screen at this point in time. Thanks for the reminder. Okay, so yeah, so as I mentioned, closer to home, you have the Hang Seng index and the CSI index not doing as well as the US and even the Japanese markets, right? Of course, this, as I'm sure you guys will already know, is really due to the acceleration of the property market that has been facing a lot of trouble in recent times, and even with the Chinese authorities stepping in to stem the further drop with tightening of regulations, preventing of further selling, right? You can see that the CSI is not dropping as much as the Hang Seng, right? Of course, this goes to show that the CSI generally is just more regulated than the slightly more open sister index, the Hang Seng index. So for me, the Hang Seng index at this point in time still serves as a very strong proxy for the Chinese markets, right? So the Hang Seng will probably take in more of the external investors' sentiment when looking at the indices. Okay, then of course we have the Straits Times Index. Year to date, we did by about 3.10%. Now, again, this is not surprising as well, because since the start of the year, right, we have seen inflation rise up on the uptick. And even just as recently, as I will share with you guys on the slides in a bit, okay, MAS, our central bank, has yet to really change the slope of the nominal effective exchange rate band, right? So preferring to take a more wait and see approach. But this is really just the start of the year, okay? Based on statistics, right? If January, the US stock market, such as the S&P and Nasdaq, and possibly even the Dow, right, closes on a high, or at least is positive in January, there is statistical evidence to show that we tend to end the year, right, on a high as well, right? We tend to end the year green as well. Okay, so that is just a little bit about correlation right there. So back to the Straits Times Index, okay, it's really more about the short-term sentiment that is driving the index right now. I will also share a little bit later on, right, of where some of the key economic news that I think we really should be looking out for in the Singapore market. Right, so going over to some of the interesting market summary, just give me a moment. Yep, okay, so quick overview of the US markets. So as you already know, especially for those of you who are very actively monitoring the markets, both the S&P 500 and the 100 equity indices have challenged key psychological levels this week, right? So going into Chinese New Year, the S&P cash index actually tested and challenged the 5,000 price level. And as recently as last night, right, the Nasdaq has actually challenged the 18,000 price level as well. Now, interestingly, what I prefer to watch, what I prefer to look at would actually be the futures indices, right? So the S&P futures or the NASDAQ 100 futures, right? Because this tend to be a bit more reflective of the forward-looking sentiment of the market. So as mentioned, interestingly, the futures indices for the S&P and NASDAQ actually already tested these levels earlier, right? In fact, before Chinese New Year, I think on last Thursday, the S&P futures already broke the 5,000 level. But it remains to be seen really whether we are going to continue this trend, right? My personal take is that we should see a strong uptick in the US indices. Interestingly, at the same time as well, US 10-year yields are edging higher, testing the 4.19% level compared to a week back. Now, for all of you who are actually watching the 10-year yields in terms of correlation with the S&P futures or the US stock indices, right? The moment the 10-year yields break this 4.19 level, right? For me, this is quite a strong signal that inflation is actually a lot more sticky. Interest rates are going to definitely be higher for longer. And as you can see, my point 4, okay, US Fed Chair Jerome Powell in the most recent FOMC open interest rate decision meeting, right? He has actually come out to say very clearly that March is currently not the Federal Reserve's base case for a pivot. Okay, and then of course on I think Sunday going into last week, he appeared on the media, 60 Minutes, right? A Sunday night program in the US. He has again tried to push home the point, drive home the point that March is too early for the US Federal Reserve to start raising rates. So this is taking all this into consideration, right? With a very strong job numbers, non-farm payroll coming in a lot hotter than expected, right? And then of course you have the PMI data coming in stronger as well. The US economy currently is still very robust and resilient, but of course short-term investors are actually watching very closely the CPI data that will be coming out in a couple of hours time later this evening. And of course, going back to point 3, the USD has also been on a very strong upwards rally since the start of 2024. If you were to look at the charts, right, it is the 7th consecutive up week so far, right? So yeah, markets. Now, STI has been consolidating sideways between the 3200 resistance level and also the 3120 support level. So if you were to actually pull out the chart, right, I'm not going to pull out the chart here right now because it's a bit consumes a bit of RAM on my PC. But if you guys were to pull out your chart, you would be able to see that STI really has been consolidating, I think, for the last 2 to 3 weeks now between 3200 and 3120. That is not a bad thing, given the fact that inflation is still so sticky in Singapore, and at the same time, of course, we citizens are worried about the cost of living, right? There are a couple of things that we are generally quite worried about when it comes to prices, right? So the fact that STI is consolidating sideways and not dropping shows that we are generally still quite resilient. And another factor that's causing the STI to also consolidate is our exposure, right? Being a smaller economy compared to our peers, right? Is our exposure to the overseas market. So that is something that local investors would really want to look at as well. Right, so moving on to point 2, as I mentioned earlier, a couple of minutes ago, MAS has previously held the nominal effective exchange rate band unchanged earlier in January, choosing to take a wait-and-see approach as inflation persists. Now, for those of you who are already in the know, please bear with me. Those of you who have yet to know, right, MAS used to announce the what do you call this, the monetary policy every half a year, but now they have actually changed it to every quarter, right? What they're trying to achieve is that, they're trying to be as current, right? Giving themselves the ability to react quicker to the market by increasing the number of announcements that they are making. So instead of every half a year, now they're doing it every quarterly. And of course, one of the biggest news for the SG local markets last week is that DBS shares, even though at the start, the sentiment was that it missed the earnings estimate, right? But the shares still surged after a 1-for-10 bonus issue. Okay. However, I would propose that investors look a bit deeper into the announcement, right? Beyond the fact that the CEO Piyush Gupta and along with the senior management has already taken a pay cut, right? The real issue here for DBS, and of course the way I look at the banking sector as a whole, is the push for digital transformation in the year ahead. I think with the adoption of new technology, with the adoption of generative AI and all these new areas of tech, right, there will definitely be hiccups along the way. The question here is whether our three major banks can move ahead, okay, without as much disruptions as we have had last year. So DBS alone last year had 5 major disruptions, right? So that of course caused quite a lot of payment issues and hit a lot of small, medium enterprises along the way. Okay, so that is the summary of what has happened in the US and the Singapore markets over the course of last week till this week, right? And moving on, I will just quickly cover the upcoming economic news events, which I think are important for both long-term and short-term traders and investors to watch. Right, so as mentioned, later this evening, we have the US CPI data, right? They'll be coming out at 9:30 p.m. And then followed that, we have on Thursday, US core retail sales data, right? So these are important data to watch out for in the US because it talks about the spending habits of consumers, right? I know the job market in the US has really been robust, right? Manufacturing numbers have been robust as well. Now the question is, are the citizens, the people, the consumers in the US spending in line with the robustness of the economy, or are they cutting back a bit more on their spending? All right, so that is the US data to watch. And closer to home, 3 important data that I've actually pulled out from Singapore's calendar, right? This can be found on SingStat, right? First and foremost, on Thursday, we have the GDP year-on-year data, right? Now, of course, GDP is not expected to change much. In fact, if you ask me, I think the GDP, we will see marginal growth, right? But if you were to ask me, this growth really comes from inflation rather than real GDP growth. And then, of course, 16 February is something that all of us will be interested in, right? It is the SG Budget 2024 speech by our Minister, Lawrence Wong. So a lot of eyes will be on this budget speech. I think one of the key things, the 2 key topics that I've seen coming out in a lot of the news and a lot of the media is really more support for the small, medium enterprises and how tax relief can actually help companies going forward, right? So these are the 2 key things that I'm seeing coming out a lot in the media as well. And then, of course, towards the end of February, right, we have the CPI data, which will be coming out on the 23rd of Feb, which is a Friday, right? So CPI data, if we're to take into consideration how Singaporeans have spending, I think earlier last week, right, we had some retail data coming up from Sinstack as well, that showed, the retail spending has actually dropped over the month of December, which is interesting because December is generally a holiday month and we should be seeing an uptick in retail spending. However, in December, retail spending has actually dipped a bit, right? It goes to show that, locally, we are a bit more careful with our spending now in the face of rising inflation. And of course, feeling the heat from the 9% GST, right, that we are facing. right? But having said all that, okay, I think Singapore market is still very resilient, as I mentioned, for the four simple factors that I have over here. So wrapping up the quick market update will be Sing dollar remains one of the most stable and strongest Asian currencies at the start of 2024. I don't see that to change any point in time, right? Especially with MAS monitoring the situation closely. And of course, in terms of stability, I'm sure you guys will already know, generally political stability, financial stability, and economic stability is one of our, actually three of our strongest characteristics. Okay, discount the fact that, you know, there's the recent money laundering scandal, right? We're still seeing flows, right? Or rather, people that I speak to in the market are still seeing capital inflows into Singapore, especially in terms of family offices and affluent wealth. All right, and of course, given the huge volatility that we're expecting across the globe this year, right, escalating geopolitical tensions, you have the most number of countries having their elections this year, with of course the US being one of the biggest elections to watch in November, right? Where you want to put your capital would be in a market which is not very hard hit by volatility. So Singapore's market, right, very resilient. Yes, it may be consolidating sideways, but that is the best, especially when you're looking for dividend play. Okay, and of course, yeah, all this stock distributions as well, right? So apart from capital appreciation, you're looking for dividend play. Singapore market is where you want to be at. And of course, we have the diverse investment opportunities, right? Not going to go into that. All right, so that's really the short sharing that I have for the market updates. Thank everyone for your time, and Sunny, over to you.
Thank you, Isaac. Thanks for the insightful sharing on what's happening on the market right now. I believe some of the points that you brought out would also be of interest of the unit holders for ESR Logo REITs as well. So may I now invite Mr. Adrian Chui to share with us their latest business update on ESR Logos REIT.
Yeah, thanks, Sunny. Afternoon, evening, everyone. Thanks for having us today. I think that's a very great outlook by Isaac, and I think some of my presentation slides, as well as the market outlook, especially the market outlook, they also dive a little bit on that and what is our views from actually from the corporate side, given his crystal ball. So I'll just do a quick presentation slides of what we have in FY 2023, the results overview, 6-7 slides, and then in summary, what did we do, and then we go into Q&A that Sunny, you could help to moderate, will be there. So for us, 2023 was a year of financial discipline and prudent actions, which we've done early, which resulted in our very resilient position for ELOG in 2023. As you know, in 2023, the big word is rising interest rates, runaway inflation, and the effect of rising interest rates on cap rates, and then values, capital values, and then hence gearing. I think we started off, if I can run through a year in review, we started off in 2023, just like what we are today. Stock market was running, everyone was running up. There is a big optimism that 2023 will be a good year coming out of the COVID after 2 years. And then before long, we know after Chinese New Year of 2023, the first bank collapsed, called Silicon Valley Bank. And then we have another bank called Credit Suisse, who nearly went under. I think the rest of the story, you will know, the rest of the year is about inflation and interest rates, rising interest rates. So we saw that coming towards the end of 2022 and early 2023. That is why we decided to take some prudent actions, because we thought that the inflation data was very concerning. We talked to our tenants, we talked to our, we look at the order books from the tenants, and we see where the supply-demand situation, and we thought that this inflation thing is real, because supply chain disruption was really bad. Inflation was a runaway. We spend money on property expenses, so we know when we want to renew security contracts, it's like 30% up, you know, and also we knew that inflation was a big concern and that interest rate is going to come in. And our concern more was what happens if interest rate continues to stay high. It will translate to higher cap rates, which will affect valuation, and if valuation comes down, then your gearing will be bad. So we took early actions by doing a fundraising in February of 2023. At the same time, we also did early divestments of our non-core assets by selling some of the non-core assets early, because we think that if we wait for the market, and the cap rates goes up, that means it's that the buyers, potential buyers will ask for a higher return. And at the same time, their funding costs will start to go up. So it becomes a double whammy. So we took the bull by the horns very early in the year to do a fundraising to recapitalize our balance sheet, as well as sell non-core assets, total about 441 million, which ended up us during the rest of the year having a very low gearing of 35.7%, and we more or less avoided the high interest rate environment, which I will share with you later. And with this, with our capital, our balance sheet strengthened and a low leverage and very little debt for expiring, we were able to continue with our operations in terms of occupancy, in terms of renting out our space, finding new tenants, renewing our leases, such that 2023 we had 11.1% positive rental reversions, and it's, if you see from the charts, it's across all our portfolio, especially logistics. Logistics was like 15%, and this is the second consecutive year that we have double-digit positive rental reversions across our portfolio, and we continue to have very high rental collections, which further ensure our cash flow stability. And at the same time, because we have strengthened our balance sheet, we don't really have to worry about high inflation and interest rates on our interest costs. We were then able to continue to complete our AEI as well as asset enhancements as our redevelopment for our 2 assets on time, and actually below our budget as well. So if you look at 2023, the keys is that we have financial discipline. We took prudent actions very early in 2023 to strengthen our to recapitalize our balance sheet, which allow us to rejuvenate our portfolio, and then allows us to enter 2024 with a much stronger balance sheets in an environment that we think that interest rate environment will probably be stabilizing. When it will come down is actually the million and one questions, but at least we feel that the rapid rises of interest rate that we see in 2020, end of 2022, coming to 2023, will probably be kept and stabilized there. If I go to the next slide, you will see that because of that, as I mentioned, our operating in 2023, our operating matrix as well as our financial position is strong, and operating matrix is resilient. As I said, we have occupancy is considerably above industry average at 92.8%. Positive rental reversions is broad-based across all 4 segments, especially the logistics and high specs driving our rental reversions. Logistics and high specs is probably a double-digit rental reversions, which is what we like to call new economy. In terms of financial position, gearing is at 35.7%. We actually have no refinancing risk going into 2024. We have, if you look at the charts, we have 2024, about $162 million of loans up for expiry, but we have already gotten a committed sustainability loan that we have, and to refinance this debt of 2024 itself. So we are done for the year, and in fact, the fixed rate debt, our fixed rate debt is quite high at 81.6%. I will give a view of what I think the interest rate outlook will be, and then how does this 81.6 fixed rate debt help us? At the same time, we have no perp callable or any coupon percentage all the way to 2027 itself. Go to the next slide, and you will probably see that this is a quick financial highlights. Gross revenue is up. All portfolio updates is what I just mentioned. I won't repeat that. The important part is with our new economy exposure is in terms of logistics and high specs accounts for 2/3 of our portfolio, 62.2%. Even though we divest our assets of the non-core assets for $441 million very early in the year, and more importantly, our 2 development properties, asset enhancement property and the redevelopment property, 7,000 Ang Mo Kio, as well as 21B Senoko Loop obtained TOP towards the end of last year. So this year they'll be contributing income, starting to contribute income as we are chatting right now. And you will probably see that our cost of debt, because of our capital management structure, our cost of debt has only gone up from 2022 3.66% to 3.91%, which is only about 0.25%, which is just very low compared to, some of our peers who probably were up like 30-40% in just interest costs. We believe that if we don't do anything this year, we don't buy anything, we don't sell anything, we don't do asset enhancements, which is not going to happen. If you don't do anything, our interest costs will probably end up staying still a shade below, maximum will be 4%. Because no lease expiring. The only thing is we need to, and our fixed rates cost is still 82, close to 82%. So if we don't do anything, I think interest rate this year will still probably at maximum go up to about 4%. So I think we're quite covered on that basis. If you go to the next slide itself, we have actually advocated our 4 strategies since the end of 2022. 2023 was about recapitalizing for growth. We have gearing now at 35.7%. We now have good debt headroom of close to about $700 million of debt headroom that we could use for our growth, whether from asset enhancements, doing more redevelopments, looking at acquisitions. We have that flexibility. In fact, and then the rejuvenation of portfolio will continue. I think one of the key factors on the portfolio rejuvenation that you will see this year for us, as we will implement a lot of our ESG as well as decarbonization roadmap, that you will see. I think sustainability has increasingly become more important to us, but we took some time to come up with what we think is the right decarbonization roadmap. Carbon tax is going to be ever increasing and will be a cost to a lot of real estate landowners, so we cannot ignore. So there is a real dollar value cost when it comes to sustainability. But at the same time, we also do not want to overdo it, because sustainability does have costs. It costs money. At the same time, it takes time to actually implement, to see the effects 4 or 5 years down the road. So I think this year we will have, but we have come up with what we think is the right balance of decarbonization roadmap, and we will be working a little more, quite a fair bit on our ESG, especially on the sustainability portion. And that is why we showed the confidence in the market that we're ready for it, and we are able to execute the decarbonization roadmap. It's actually an executable roadmap, and that is why we're confident enough to refinance our 2024 loan of $160 million with a sustainability-linked loan itself. Now, going to 2023, we think that, I think in conclusion and outlook for what I have is that, I mean, we avoided the big rise in interest costs, the negative downside of the big rise in interest costs, as well as cap rates, because we took action early. So the safety in the balance sheet and the safety in the REIT is no accident. We saw it early. We saw the signals early, the warning signs early for higher for longer interest rate environment. We took our actions by recapitalizing our balance sheet, as well as divesting the non-core assets, which allows us to continue to rejuvenate our portfolio and managing our capital management with higher fixed rates of interest of 81.6%. And you will note that our hedge tenor is only 1.3 years. That means we have hedges in place that covers 81.6% of our loans in fixed rate for 81.6%, but the remaining tenor is only 1.3 years. We think it's a good spot. It's because our sense of it is that interest rate, at least for the first half, will continue to stay high. Any rate cuts, I mean, Isaac has mentioned, Powell has mentioned that March is too fast a time for rate cuts. So I think the higher for longer is still going to stay, at least for the first half. But as I said, interest rates are stabilizing. The question is, when is actually the rate cuts? Our hedging tenor of 1.3 years allow us that flexibility. If interest rates starts to drop and dip downwards, I think we can extend our hedge tenors longer that we have. So we are quite well placed, give us rooms to reduce our percentage hedges as well as extend our hedges. So I think that is important in coming interest rate management. Now, I have investors, especially institutional investors, asking my view, and I have sort of mentioned to you what I think interest rate will be. My sense of it is interest rate is probably going to stay high for the first half. The first cut could probably come in July, earliest June, probably July, August. And I think it will then stay there until the US elections are over. So that is why I think 2024, sorry, I don't think you will see interest rates dropping by 2-3%. It's not going to drop as fast as it rises. At best, my sense of it is second half of the year, late second half of the year, then you will see meaningful interest rate drops. I mean, maybe good for the stock market when interest rate pivots down. But I think for us as long real estate investors, the key part is that we were to really watch out for our interest rate expenses, because as you can see from most of the results this year for S-REITs, interest rate has risen 40-50% of the total cost, and it has wiped out probably a lot of good rental reversions on the top line as well. In terms of market outlook, our feel is that we are cautiously optimistic. Supply of industrial space, especially in Singapore, has definitely gone up as compared to the previous years when it was still hampered by the backlog of COVID, lack of manpower as well as materials and higher costs. But even though supply has gone up, I would say that over the next 3 years, probably about 1 million square feet, on average 1 million square meters of industrial space is coming up, but only 27% of that 1 million average per year over the next 3 years is actually from warehouse spaces. So warehouse space is still quite supply. Supply is quite tight over there. I think even though the supply is much higher than previous 2 years, but we think that the demand side will balance out this supply on industrial space. Primarily 2 reasons. I think number one is that the continued geopolitical tensions that's going around the world will end up having will result in continued supply chain disruption, persistent supply chain disruptions. And whenever there are supply chain disruptions, it actually bodes well for logistics assets. At the same time, I think we see that our tenants from the manufacturing sector, especially the electronic sector, are ramping up their production. We spoke to some of their tenants. They're saying that they're seeing orders coming in because the last 12 to 18 months, what they've been telling us that the inventory of all their electronics components and all has been coming down. So orders are coming in as well. So we see some early positive signs of expansion in the manufacturing as well as electronic sector. So this will drive demand primarily for logistics space as well as high-spec space. So we probably expect the positive rental reversions to still be in the positive territory for rental reversion from these 2 segments, of which E-Log has 62%, 2/3 of portfolio exposed to. And hence, I'm still guiding analysts that we will still see positive rental reversions in our portfolio in 2024. But the percentage of increase will probably not be double digit, will probably be in the higher single digit of about 7 to 9%, and logistics will still probably continue to drive that space. One thing to watch out for is that because I sense that the inflation will still stay high, one thing to look out for is actually our impact on property expenses. I think for us, the good thing is that property expenses has 2 major components. I think the first one is maintenance costs. The second one is actually utility costs. I think what we're lucky is that the utility costs, 90% of our utility costs are passed through to the tenants. So if Singpower raises 10%, we will basically raise 10% on the contracts with our tenants anytime. So I think utility costs, we are quite, I think more or less quite covered. But I think the property maintenance costs like security, cleaning, and all, that is the one that we have to watch as well. And also this year and probably next year going forward, quite a fair bit of money will also have to be spent on CapEx to make sure that our buildings adhere and are able to provide sustainability features. So I think overall, I would say that this year, we're still pretty optimistic. And in terms of 4R strategy, this year will actually be more of a looking at recycling our capital. We've raised money, we sold assets. We have only, out of the headroom of $700 million, we have only so far spent about $100 million sync, which we invested in ESR Japan Logistics Fund, which and indicatively is about 5% yield, but we're funding it with very cheap Japanese debt at close to about 1.5% fixed for 4 years. So I think that is a very, very good spread. That's why you can see that when we did the announcement, it was a DPU accretive of 1.8%. And importantly, these are modern logistics properties. The fund has 5 modern logistics properties that's located in Tokyo, Osaka, as well as Nagoya. These are the key cities of Japan where economic activities actually are centered on. So I think this year I will be looking at recycling some of the capital that we have raised as well as asset proceeds that we have sold to look into some of the assets. And we will be continue our strategy to rejuvenate our portfolio to make sure that the portfolio is modern, it's new, it's what we call future ready, and that the underlying land leases that we're going for the assets are longer leasehold or even freehold assets. So overall, that's what I have for my presentation today. I hand back over to you, Sunny, for Q&A.
Okay, thank you, Mr. Adrian, for that very detailed sharing on the business update for ESR-LOGOS REIT. Very commendable performance there for the full year, double-digit percentage growth in revenue as well as the MPI. So now we will move on to the Q&A session. Please feel free to submit your questions in the chat, the Q&A. For our Facebook and Mumu audience, do click on the link to join us in Zoom to post your questions. Already I'm seeing on the Q&A, we are seeing 10 over questions coming in, and we do have some pre-submitted questions earlier on. We'll try our best to get to as many questions as possible. So now, without delaying any time, I will just go through the questions on the Q&A with Mr. Adrian Chui right now. So, Mr. Adrian, thanks for the insightful sharing and your take on the interest rate that is going to move this year. I think I'm in line with what you said. We expect the first interest rate cut to happen second half of this year, but how much of the cut, we don't know yet. Okay, so but one of the questions that we have here from one of our viewers, which is from KH Yap, one of the key investment merit of the merger between ESR-LOGOS was that the transaction would be DPU accretive. But yet, since the merger was completed, the DPU has been falling, while a higher interest rate has been responsible for some of it. Are you able to help to quantify to unit holders whether the cost savings and other merger benefits has been realized?
Yeah, firstly, I mean, one of the reasons, as you will see, that the DPU has dropped is because we sold assets. When you sell assets, you don't have revenue. That's where your DPU drop. And the key is actually to redeploy these assets into better quality assets and all. I think one of the key one is that we sold assets, 441 million. Once you sell assets, there's no revenue, you can't pay out debt. And we use the money, obviously, to pay down the debt first, pending the redeployment. I don't think we want to rush into redeploying for the sake of redeploying. Some of the non-core assets that we sold off left 25 years of land lease. And I share with you, and I said this a very ago, is that if investors are worried about HDB leases having 60 years of lease, can you imagine you have 25 years of land lease remaining on your assets? All right. So if you do a simple mathematics, 1 divided by 25, that means that every year you're losing about 4% of capital value. You don't do anything, every year, next 25 years, you're going to lose 4% of capital. You're going to lose money anyway. So if you can have a positive rental reversion of 5%, but everything will be eaten away by the fact that the land lease is getting shorter. And if you face an environment where interest rates coming up, you're going to get double whammy because the cap rates is going to go up. And that's why, so that is why we divest all these non-core assets that we have. Clearly, the merger benefits has come to us is because that is why we are able to register double-digit positive rental reversions. If you see my slides from 2020, since the merger until even today, every quarter we do business update, you will see that every quarter logistics and high specs building are the ones that's giving you positive rental reversions. We can do two things. We can sit down here and not do anything and hope and see every year 4% of the value start to come down. Or you can do something about it by doing asset enhancements, redevelopments, to make sure that you continue to make sure that the assets are continuing to perform. The assets are able to drive, to have longer runway for you to earn your earnings and all. So I think large part of it is that the DPU is probably because we sold assets. And as an active manager, that's what our job is to do, is to make sure that we can rejuvenate and make your assets future ready. I mean, there are some REITs who don't do anything, and in our sector, I don't know what is their plan, but for us, it's quite clear. We have a sponsor that's strong, that's able to give us pipeline of assets, and it's good quality pipeline of assets. I share with you the investment that we have in the Japan Income Fund, where it's 1.8% DPU accretive, that's $100 million, US 70 or 100 million equivalent that we put in. These assets are not available to our competitors or our peers, our listed peers. It is only available to us is because it's part of the ESR family. The assets there, the 5 assets there are freehold, Tokyo, Osaka, and Nagoya. I would have loved the whole portfolio is worth about $1.7 billion. But I can't go in and buy. I don't want to be doing a big transaction and then buy something that's big and then such that it becomes non-digestible to us. We want to make sure that we have a foothold in, we have exposure to those assets, and when we start to grow, we become a little bit bigger, we can do bite-sized acquisitions such that it is something that we can digest and not go in and do a big bang and buy like $1 billion worth of assets and then we struggle ourselves to try to understand the market or try to do it. But this type of 100 million where we have about 8% stake inside allows us to understand what the market is, access to freehold assets, and at the same time allow us the pipeline that when we think is right, then we can buy those assets. This is my reply to the question from Mr. Yap.
Okay, thank you, Mr. Adrian. Yes, I think ESR-LOGOS is actually actively managing the properties with the lease towards the tail end lease where the lease decay becomes very real. And that is something of a concern that ESR-LOGOS is actually looking at. An expansion of this question, which was one of the questions that was submitted pre-program. What would you be able to provide any guidance on the DPU, which we spoke about just now going forward?
No, I don't think we're allowed to do that. That would be a real forecast. I think this is something that the regulators will not allow us to do that. But we do give guidances on the various components. Primarily this year, I think a big component actually will be debt cost. I think I guided investors on the debt cost. In terms of, I mean, the three big components obviously will be rental reversions, debt costs, and then you can work out actually what will be the numbers. And also investors are also guided asking, I mean, not investors, research analysts are guided ask then, when are you going to use the money? Are you going to stay at here it is, or you're going to spend how much? And we give them guidances, and the smart guy will be able to work it out. You know, you don't give the final answer, but you give enough hints that they can actually put it in Excel and work out the numbers, or some people even press calculator, you're able to work that out. I think that this year the biggest component will still be debt costs. I think that's why we make sure that we address that. We refinance early. I think there's a question from Mr. Chai Cho. I think it's Mr. Chai. If I pronounce your surname wrongly, I think it should be Mr. Chai. Will that cost increase again in 2024? Yes, of course, because only 81.6% of our interest rates are on fixed basis. There is still another 18% that is not on a floating basis, which is on a 3 months basis. So even if I don't increase this debt, this 12% will get marked to market, and then it will be at where the current higher for longer interest rate will happen. So that's why I guided you. I guided the market, I guided the investors just now. And this is public anyway. I did guide research analysts as well as my other institutional investors that we are 3.91%. And this year, if we don't do anything, we will probably end up maximum 4%. But that's still very low compared to all others.
All right, so thank you for addressing the second question as well from Mr. Chai, as you said. So we can't really give a guidance on the DPU, but if you read between the tea leaves of what Mr. Adrian Chu has shared, the direction of where ESR-LOGOS is going, you will get a hint of where the DPU might be heading. Okay, so we move on to the third question on the Q&A by Mr. Alex Ng. Why were some of the properties in Singapore divested at below book value when industrial properties are in demand by investors?
Because there is fundamental called land lease. If you have a land asset that has a land lease that is left 25 years versus an asset that has a land lease of 50 years, I think the pricing is very different. That is why you always see, even in residential, a freehold asset and a leasehold asset that is side by side command different prices. The assets that we are selling are leases that's less than 25 years. If you look at the assets that we divested in Singapore, about $330 million, it was divested at about 4.3% discount to valuation. Now, if I don't divest it and I hold it for 2023, these assets will lose 4% anyway, because the underlying land lease will get shorter by 1 year. So on paper, it looks as if you're divesting at discount, but the answer is that it is a non-core asset. I cannot do anything. People like to think that for industrial properties, wow, 330, Adrian, you're crazy, right? 330, such a big amount. Guys, it's not one asset. It's made of 6 assets. Each asset is $50 million. These are very smallish footprint, and some of these assets are already like 20 to 30 years old. Industrial assets, I like to share a little bit, is very different from office assets. Office assets, useful life tend to be close to 30, 40 years. Industrial assets, probably useful life is 15 to 20 before you need to do a major enhancement or redevelopment, because technology changes. The building may not have enough power, may not have enough specifications to attract the advanced manufacturing that the country is bringing in. I give you an example. Those 5 assets that we sold, there's no way that you can pull in more power. The loading is fixed. So you cannot have big machinery with kilonewtons of machinery on that building, because the loading is not there. These properties cannot become data centers because there is no power to it. Some of our assets that we sold, even the ceiling, you can't even put solar panel, it will collapse. But there are so-called other end users who are willing to buy that for their own personal use. They don't care about solar panels, or they don't need that kind of power for their own businesses. So that's why we sell them. And as I said, you know, during time when we decide whether to sell or not, interest rate was still quite low, but we know that interest rate is going to double. If interest rate is going to double, cap rates are going to go up. And if you wait a bit longer, the investor, the buyer, will also have higher funding costs. So they'll come back and negotiate the price with you. So we locked in the price pretty early last year with them to have that. And we made sure that the guy, the buyer, actually has money. He needs to show us proof of funds and not say, oh, I agree with you first, then I go outside and find money. No. Then we don't want to deal with this sort of buyers. Show me that you have the money, you have the funding in place. Okay, then let's talk about price. So I think we did the right thing on that.
Okay, so that will answer Mr. Alex's questions on why some of the property are divested at below book value, mainly because of the lease decay and of course new requirements of tenant that the old building cannot fulfill. Okay, let's next move to the next question by Mr. R. Huang. I hope I get the gender correct. Okay, so what is the positioning of ESR REIT versus the others?
Thanks. I think what is the positioning of our positioning is quite straightforward. We want to be a new economy REIT, and we focus primarily on logistics and high specs.
Okay, that's the first part of the question.
Yeah, so logistics is our, if you look at the ESR group, our birth and our skill sets is in logistics, development, maintaining, tenants filling up the space. The legacy of this REIT that we inherited was that there were business parks assets and there were small general industrial buildings. And these are the general industrial buildings that we are looking to divest because they're this non-core, they're too smallish. It doesn't make sense even for me to redevelop. When you want to redevelop an industrial building, there must be certain scale, or else it's just too expensive on a per square foot basis. And on top of that, construction cost is also going up. So our focus will really be on high specs as well as logistics. Logistics now makes up about 51% of our portfolio. High specs is about another 11%. We hope that with our divestments and recycling our capital into redevelopments, asset enhancements, and even acquisitions, our share of this 62% will start to go up towards 75 or even 80%. Now, I can share with you that business park, we are not the champions. We are not the no, we have the skill set, we have the tenants, we know how to manage them, we know we have a relationship.
And the high spec kind of industrial client base that we are looking at. And R. Huang also have another question. Is there any catalyst that we should be looking out for ESR?
It's an indirect way of asking me to give you a forecast. So the answer is very simple. If you believe that the logistics and high spec sector is going to be the one that's going to be beneficial we're going to be the one that's beneficial from the demand as well as all the circular changes that's happening around the world, I think this is a segment that you should need to look at.
Okay, so let's move on to the next question by Mr. Xiao, Mr. ML Xiao. Is ESR REIT using AI? I believe I read that question correctly. Generative AI impacting on the company and industry.
I think at this moment it's still early, Mr. Xiao. I think clearly some of our logistics tenants or the operators, they are start looking at AI. on that. But at this moment, Mr. Chia, I can't really take that because I haven't really studied into that. Actually, our focus right now is more on sustainability. Really. I mean, that one is a more bigger thing for us than I would say AI for the time for this current moment. Yeah.
Yeah. I think I agree on that. Sustainability will be, if not managed properly, will become a cost to the company. AI would be something that will come in next in line. So we move on to the next question from Mr. Chris Lim. May I know what are the long-term plans for investment into that Japan income fund?
That's a great question. I think, Mr. Chris, I think it's a great question to be asked. And I've asked a lot of times by this investor. What we are doing in a Japan income fund is very clear. We want to put our toes in so that, because as part of the investment in the Japan income fund, we actually are able to receive all the performance of the assets, how it's performed, all the investment decisions that the investment fund has to do, but we all have a stake in it. So it gives us that valuable information of how the assets are performed. It's the various assets inside ready for acquired, ready to be divested. And if it's ready to be divested, we come in first. We are first in line. So our intention will always be to that in the future to be able to buy these assets that's inside the Japan income fund directly, just like what we did for ESR Sakura last year in October 2022. In short, Chris, what I'm sharing with you is that it's as good as me in local parlay or in local example is I'm putting the tissue paper packet on the table right now with my investment into the Japan income fund because it allows me to get the information to know how it is performing. So when I believe that it's time to acquire, it's already balanced, I can offer to my partners and say, I want to buy it. Now, the partners may say, Adrian, I may not want to sell you. I may want to call a tender open outside, to have people to bid. Sure, I can participate. But at least when I price, I have more information than others. And if others pay for a much bigger price, sure, go ahead and take it because I can't afford it. And I won't force myself to buy something that's overvalued. And I still have a 9% stake and I will I will gain the 9% upside. And if I buy at the price that I think is a market, technically we are buying at a 9% discount because we bought it early at 9% stake. So I think this is really the strategy is ultimately the long-term plans for the Japan income fund is to buy the assets that is directly in the Japan income.
Okay, so ESR has this chope the seat in the Japan income fund.
It's the next packet in there,
next opportunity come, ESR will be first in line to get it. Okay, so let's move to the next question. We are about 5 minutes to 8. Mr. Gerald Lim, Mr. Chui, can you please share more about the newly completed Ang Mo Kio Avenue 5 property impact on the rental income, please?
Yeah, I think we have got 60. When we got the TOP in November, we already got 48% occupancy. And then 2 months later, we now stands at 62%. It started to contribute income, and it's in line with what we were expecting anyway when we did the AEI decision 2 years ago. I think what we will see is that we are targeting to have this year, at least that by the end of this year, to have the occupancy of that asset being raised to close to about 80 to 85%. Yeah.
Okay, thank you for that. The next question by Mr. Alex Ng, DPU, NAV, and then the projection ahead, change in trend. I think that's what Mr. Adrian Chui talked about earlier. He cannot give the full crystal ball, but he did polish it a bit and to tell us what is the trend of.
Yeah, I would probably say to Alex and also a lot of unit holders who have been asking me every year on this. Now, our portfolio are not new. Okay, this is a reality of that. We have assets. We have, I think I put it on the presentation, we have close to 9% of our assets that has less than 10 years of land lease remaining. Another 7 to 8% have less than 15 years remaining and so on. So our portfolio of assets are not new. What would have been new 15 years ago is not new anymore. I cannot sit down here and wait and just not do anything. You will see that not only your NAV will continue to drop, but your DPU will probably continue to drop because the assets become old if you do not rejuvenate. I have assets sitting on my balance sheet that's worth only $20 million. There's the present period of time, I have assets that's worth $9 million. We have put out our strategy back in 2022. We are executing on it to make sure to rejuvenate. And that is why 7,000 Ang Mo Kio, even before TOP, you're 50% occupied. 2 months after that is occupied. 2 months after TOP, you are 62%. 21B Senoko Loop, it is an old general industrial building. old general industrial building that actually has workers' dormitory that's there. And then after COVID, JTC do not allow the workers' dormitory anymore, and it become empty. We went out, we go and see going to talk to NTS, and we got them to do a bid to suit our high specs. So this is what we do, and this need patience. This is not Lego. You need 2 years, you need 12 to 15 months to rejuvenate your assets, redevelop. AEI is faster. 12, 15 months you can do it. A full development takes 2 years. So we are rejuvenating the portfolio to make sure that our underlying land leases are addressed. All right, and then we make sure that we don't rush into buying assets for the sake of plugging short-term DPU. We will continue to sell assets. I've guided analysts that this year I will still be selling $200 to $300 million worth of assets, because these are just, I can see where it's coming, right? The assets, the land leases will get drop and drop and no more. So we are rejuvenating the portfolio. We started last year, we're doing this year as well. And I have institutional investors telling us that they like us for being active managers. Not just issue money and then buy assets. You also sell assets to recycle. And we are being active about ourselves. We see rising interest rate coming. We raise early, we sold early. So we have institutional investors telling us that that's what you're doing the right thing. At the same time, at the end of last year, when the market was way very, very bad, I think September, October, you'll be aware, interest rate fears were the longest, higher for longer. All market collapsed. Share price dropped from 32 at NAV all the way down to 25. We were sitting on a pile of cash. So we decided to do unit buyback and return the confidence to the market that, hey, operationally, we are fine, right? And we just did a small unit buyback and we are back up to 32. And I guess this is what and unit holders actually asked us, some institutional investors said, guys, why don't you just do a unit buyback? And during that time, it's correct, because at 25 cents, you're trading a double-digit yield, 20% discount to NAV. No other investment or AEI can give you that kind of return. So the sensible thing is to actually do that. And we did that. And that is why I think the institutional investors are telling us that what you're doing from the asset regeneration, asset recycling is what they expect us to do. And we are executing it. So if people are looking at short-term pop, or what you like to call catalyst, I'm sorry to disappoint that I can't turn my assets overnight from leasehold all the way to freehold just overnight. Yeah.
Okay, so thanks for sharing that with us. The time is 8:01. We'll just take 2 more questions, Mr. Adrian. One of them is on rental reversion and rental delinquency. I think on your presentation just now, rental reversion is double-digit percentage positive, and rental delinquency is like less than 1%. You want to reiterate that again?
Yes. So I think Daryl, sorry, did I just say Daryl? I think the updates on rental reversions, as I said, is 11.1%, second consecutive year of double-digit. I go one more step to guide you that what we think this year the rental reversions will be. We think will not be double-digit anymore, because the low bases are already overcome already. But we still think that because of the supply demand, especially for demand side with geopolitical risk, supply chain disruptions, and the manufacturing electronics and manufacturing outlook is to be more rosy, better. We think that our positive rental reversion this year, portfolio rental reversion this year, will be about 7 to 9%, still a high single digits. Rental delinquencies since COVID till now is always 99%. Yeah, some institutional investor joke that our guys are better at some of the loan shark runners in collecting debt. I don't disagree with them. It's a good compliment. 99%. We don't see such rental delinquencies that's coming to us.
Okay, one final question. I'll just sum up some of a few questions on the Japanese acquisition. One of the questions by Mr. Xiao ML was that the Japanese acquisition acquired in late 2022, the SGD value was 187 million. The latest valuation in December 2023 dropped to 173 million. So what would you have to say of this? Maybe I add on a few points. This earlier part of this year, we saw the Japanese having an earthquake, and then the Japanese Bank of Japan actually pushed back their interest rate hike towards the later part. So those are some of the concerns that are the external environment that affects valuation. Your take on this, Mr. Adrian?
No, I think with the 187 million, what you think is total price, including all your due diligence costs in terms of the setup costs and all. But in terms of valuation of the underlying, it has not changed actually. In fact, they didn't change by much. there was, in terms of evaluation of property, it did not change by much. What you see in the difference for some of the years that in 187 includes some of the acquisitions costs as well as the setup costs and the legal due diligence costs. But having said that, there is also a drop in turnout because of FX. Japanese yen versus now today, when we bought in October 2022, I think the yen was about 102. I think end of last year is was about 108 or 107. Or when it started, sorry, it was 100. Sorry, when there was 100. So there was a little about FX change of about 7%.
Yeah. So that will explain the devaluation
some
part
of it, yes, some of it.
And
in
of course,
dollar terms, but in Japanese yen, the valuation has not really changed.
Yes. Totally understand that. So as you can see, what Mr. Adrian Chui shared about the interest rate projection right now, in the Japanese market, we are looking at Bank of Japan increasing interest rate later part of the year, maybe. So that would also probably strengthen the yen again, and that is something that we should be looking out for as well, right, Mr. Adrian?
Yeah, I think so. I mean, the problem, I think the problem faced by most REITs in Sing dollar, it's not that the market that they're investing in, whether Japan, Australia, or UK, is weak, you know. The problem is Singapore dollar is strong, you know, and as long as inflation, I mean, Isaac is the best person to tell, right? Until inflation is really managed now, Singapore is going to continue to manage our inflation with this what he calls NER. I call it layman terms effects to prevent imported inflation. You know, so I might share with you that Sing dollar will be strong. I mean, you just look at the causeway, across the causeway, and now $1 is 3.5, man. You know, so but you have to look at fundamentally in that country, is it something that from a longer term, is it something that you want to invest in? FX will always be there. I'm not an FX guru. I'm a real estate guy. I look at what the underlying asset is. Freehold, is it future ready? Who are the people that can I'm not an FX guru. If I'm an FX guru, ESR-LOGOS REIT will be an FX fund, but I'm not. What we try to do for a hedging policy is, as far as possible, when we want to invest in Australia and Japan, get the highest LTV on the local currency. That is what you need to do. Then after that, you look at your dividend. Then you look at the asset that you buy. What are the leases? If it's a single tenant, okay, the whole business signs with you 10 years and it's very predictable every month, go and do the income hedge because you have very predictable income. But you don't hedge for 10 years because it will cost you a hand and a leg. You probably, for our policy, we will hedge income that is visible for at least 12 months because we pay half-year dividend. And it can be very, very expensive if we do like hedge like up to 7 years. So you will have the FX risk. My sense of it is that I'm not an FX guru, but I think that as long as Singapore inflation continues to be at a 4-5%, I think you're going to see the Sing dollar to continue to be very strong. But will it forever be 4-5%? I don't think so. At some point, inflation will come down, interest rates will come down, and we're back to. And if you look at 10 years, I think we should be okay.
All right. Okay. The time is about 8:07 now. I'd like to thank Mr. Adrian Chui for staying back with us an extra 7 minutes. Thank you for your precious time.
Thank you.
We hope the viewers today also found this corporate session informative as well. If there's any additional questions, we might trouble Mr. Chui and his IR team to flash the contacts for the IR for ESR-LOGOS REITs over here. But do email the companies if you do have further questions. And in case you miss any part of today's session, you can rewatch this webinar on our SIAS YouTube channel as well. So maybe we are going into the closing slides. Corporate Connect is our monthly webinar. We do visit our website to get updates on our upcoming investors education program and initiative. The next Corporate Connect session will happen next Tuesday for Far East Hospitality Trust. You may also type in the chat box to let us know which listed company you would like us to feature. We will hope to see you more in the next Corporate Connect in 2020. And of course, welcome back. So thank you everyone for joining this evening. Take care, have a good night, and have a good happy Chinese New Year.
Thank you everyone. Thank you.